Okay, so probably half of the room or more, based on my survey at the beginning, said that they were under 50. What I'm going to talk about next is what the obligations are for a large employer. So you run all those numbers I just talked about for 2014. You average out above 50 for the year. You can't take advantage of the seasonal worker exception, so you're subject to the mandate next year in 2015. I'm going to talk about what your obligations are. Now, for those of you who are under 50, as I mentioned earlier, I think it's still worth considering all of this, because you may get there at some point, and you're going to want to know what are the consequences going to be if I go above 50. But what we're talking about next is only for those employers who are going to hit that average of 50 or more in 2014. If you're not going to hit that average, then you don't have any obligations. You're not subject to the mandate, which means for you, it remains 100% a business decision in 2015. Whether you're going to offer coverage, if so, to whom, how much you're going to charge for it. Okay, that's if you're a small employer. It's only the large employers that have this new layer of regulation that may dictate what kind of coverage you provide. So let's talk about the mandate. The basic concept is you have a choice if you're a large employer starting in 2015. You can play, meaning you can offer coverage to your employees and make sure it's affordable, or you can pay, which is basically paying a penalty tax for the privilege of not going through the trouble to offer coverage. I want to start with talking about how it is that you would play. So this is the employer who doesn't want to pay a penalty. They want to put in some sort of plan that meets the minimum requirements so that they can avoid having to pay a penalty. So the first thing you need to do as a large employer is you need to make an offer of coverage to substantially all of your full-time employees and their dependents. Now here we're talking about folks who are full-time employees. The concept of a full-time equivalent is irrelevant once we get to this point. You only take into account full-time equivalents when you're doing that 50 or more test. Once you get past it, your obligation as a large employer is only to those employees who are actual full-time employees. They average 30 or more hours a week, 130 hours a month. Some of you have probably read about all the employers that are out there reducing the hours of part-time employees. I tell lots of my clients, the days of the 32-hour-a-week waiter are gone, right? What you're seeing in the retail industry, hospitality, lots of industries where historically you had folks that were working 32-hour shifts, 35-hour shifts. Those are all being shrunk down to 28-hour shifts. And the reason for that is these are large employers who have an obligation, but they can manage that obligation or reduce it by making more use of part-time employees. Because whether you're going to pay the penalty or whether you're going to play and offer coverage, the obligation is only to full-time employees. So, number one, you got to make an offer of coverage to substantially all your full-time employees and their dependents. That offer of coverage needs to be a plan that provides minimum value. Minimum value is what you've probably read about as the bronze plan. Okay, the bronze plan is a concept of sort of the minimum plan that qualifies as good coverage for purposes of healthcare reform. And the basic concept is that on an actuarial basis, the plan will cover 60% of the cost of benefits. So I'm not talking about premiums. This is, you've paid your premium, you're in the plan, you go to the hospital. On average, the plan has to cover 60% of the cost of whatever coverage you're getting. And what you'll find is some pretty thin plans will satisfy this minimum value standard. Most of you have probably heard of the high deductible health plan. It's been pretty popular the last probably 10 to 15 years. And this is sort of like catastrophic group health coverage, right? It's, the plan covers, preventative care because it has to. It covers certain other things without a deductible because it has to. But any major expense, there's, a $5,000 deductible for an individual, or maybe a $12,000 deductible for a family. Even those types of high deductible health plans will generally satisfy this bronze level standard of minimum value, just to kind of put it in perspective. The reality is, if you're going out and you're buying a group insurance product for your employees, you're going to be hard-pressed to find a plan that doesn't meet the bronze level, because it doesn't really, it's not of much use to employers to provide a plan that's not bronze. So it's got to be a minimum value plan, and then the coverage has to be affordable for the full-time employees. In order for the coverage to be affordable, the lowest cost employee-only coverage cannot cost the employee more than 9.5% of their income. Now, the only way I can get my head around this, because they couldn't have made this any more complex, is to go through an example, this affordability concept. So let's walk through an example. So you have a full-time employee. They have household income of $30,000 a year. So you multiply that by 9.5%. This is how much they can be made to pay for your coverage for the year in order for the coverage to still be affordable. So if we bring that out to a monthly amount, $237 a month. So you as the employer, you go out and you find, the cheapest bronze level plan you can find. Maybe it's an HMO or kind of a lower level PPO plan, and it's $350 a month, which is probably pretty close to what you're going to see out there in the marketplace. So what that means is, in order for that coverage to be affordable, you as the employer are going to have to subsidize it to the tune of $112.50 a month, so that the employee's out-of-pocket cost in this example is no more than $237.50. Now, when it comes to affordability, they could have made this a heck of a lot easier just by saying, okay, employer, in order for your coverage to be affordable, it can't cost more than X, or you have to contribute a minimum percentage or a minimum dollar amount. They didn't do that. Instead, what they said is, you have to back into how much it'll cost you, the employer, by looking at the maximum amount that you could charge an employee. So that's how you figure out affordability. Now, this 9.5% concept isn't just pulled out of the air. It fits in with the rest of the statute. You may remember earlier we talked about the exchange coverage, and how if your income is between 100% and 400% of the poverty level, you'll get a subsidy. The way that subsidy works is, if you're under 400% of the poverty level, you will never pay more than 9.5% of your income for coverage in the exchange. So the policy decision by Congress that's weaved into healthcare reform is basically that nobody should have to spend more than 9.5% of their income for coverage, whether they're getting it from the government through the exchange or whether they're getting it from their employer. So that's how you make sure that your coverage is affordable. Now, a lot of employers will offer multiple plans. Maybe you'll have that high deductible, low level plan, you'll have an HMO, and maybe kind of a rich PPO. It's a package, and each employee can kind of decide which one they want to buy depending on their needs. The requirement for affordability is that you just have one option that meets this requirement. Okay, so you're going to put in that lowest level plan that you can, make sure that it meets these minimum requirements, and then if you want to have buy-up options for your employees, where if they're willing to spend the money, they can get that higher price PPO, that's okay. You don't have to make sure that every single option satisfies this 9.5%. You also don't have to make sure that employee plus spouse, employee plus dependents, employee plus families, that those higher levels of coverage don't have to meet this affordability. The only thing this affordability standard is based on is employee-only coverage. So in this situation, let's say family coverage was $1,000 a month. You could make the employee pay the full difference, the full $650 additional dollars to buy that family coverage, and it's still going to be considered affordable for purposes of healthcare reform. And a lot of employers do that. I mean, this is my big concern about all these employees that went out to the exchange, because at the exchange, if I'm eligible for a subsidy, it's not just for coverage for me, it's coverage for my entire family. If let's say my income is 150% of the poverty level, I might be able to get family coverage for my family of four for $100 a month, $75 a month, depending on the tax subsidy. But when I go get it from my employer, all my employer has to do is make sure the employee-only coverage is affordable. And that's what's going to happen, is people are going to get upset because they lose that family-level subsidy in the exchange, and in return, they get this employer subsidy, which is only on the employee piece. Now, the other thing to keep in mind is that all you have to do is make an offer. You don't have to make sure your employees actually buy it. And let's face it, a lot of them aren't going to buy it, right? Doesn't matter how cheap it is. If you're making 10 bucks an hour, 12 bucks an hour, you may not spend the money, right? You might have a young, healthy workforce and they don't think they need it. They don't care about the penalty, you know, if they even file their tax return. But remember, all your obligation is as an employer is to make the offer of coverage. If they decide not to take it, it's not a problem. You're not going to be penalized. Questions?
You have to have them sign some kind of a waiver?
Yeah, so if an employee decides not to take your offer of coverage, there's no absolute legal requirement that says you have to have them sign a waiver. However, as a best practice or a recommendation from an attorney that does this for a living, I would say yes, you're going to want to have signed waivers from any employee who doesn't take the coverage, because remember, this is now a tax record. You know, if you get a penalty bill from the IRS 18 months later, you're going to want to produce documentation to say, no, I don't owe a penalty for this person because I made them an offer of coverage, and here, you can see here they declined it. So you're going to want to get signed waivers in order to prove that you made that offer of coverage.
Just per employee, because obviously
Sure.
so many employees
Sure, good question.
contributing a different amount of income.
Yeah, well, that's a decision you need to make as an employer. How are you going to price your coverage? I can tell you that what a lot of my clients are doing is they've always set premiums somewhere. You know, maybe like the employer pays 80%, employee pays 20%, or the employer contributes X and then the employee pays the rest. What a lot of employers are doing is they're sticking with that process. You know, this is how we price our premiums. But as a safety valve, they're saying that if based on your income, that would cost you more than 9.5%, you'll pay a lower premium. So that's one way to do it. Another way to do it would be, yeah, to price it for every employee. I have some clients who are just adding a 9.5% load on every dollar up to whatever the cap is. So if you say, okay, employee-only coverage costs $150 a month, you're going to take 9.5% of every dollar during the month until you hit 150. You might not hit 150 with some of them, right? It depends on what their income is. And that's a way to, in effect, individualize it for every employee up to the cap. So you have to decide how you want to do it. Now, a lot of people hear this and they say, well, wait a minute, isn't that discriminatory? You know, you have some people paying one rate, you have some people paying other rates. Well, at the end of the day, you're charging lower paid people a cheaper rate. And that is not a discrimination issue in any legal context. So that's not a problem. And if you're charging people by the percentage, some people say, well, wait a minute, then you're charging the higher paid people more. Well, there's no legal context where that's a concern either. So it's basically there's no discrimination issue for those of you who might be thinking about that.
Are owners in a different bucket?
Are owners in a different bucket? So owners, if you are an owner employee, meaning you're a shareholder, membership interest holder, whatever you want to call it, you don't count for purposes of that 50 or more test, and you don't have an obligation necessarily to yourself under this. Basically, you're disregarded as an employee owner, even if you're paying yourself a W-2 salary. Now, you'll still have an individual mandate obligation that you want to address, and I haven't come across too many owners that didn't want to pay for their own coverage one way or another. But as a technical matter, owner employees are basically disregarded. But don't think that means that the whole family's disregarded, right? You might have family members working for the business who aren't owners. They still count. A lot of employers say to me, well, wait a minute, how do I know what my employee's household income is, right? You may have an employee who has 2 or 3 more jobs. You may have an employee who has a working spouse. There are a lot of other sources of income beyond what you pay. And the answer to that is there's no way for you to know. all right? There's no mechanism by which the IRS is going to tell you or any other government agency. And my recommendation to my clients is I don't even think you should ask, because I don't think you're going to get an honest answer out of most of your employees anyway. And I think a lot of employees get intimidated with that type of questioning. So I don't think it's a good idea to even try to do some due diligence and get it. So one thing you could do is you could guess. I mean, I have some clients who say, well, I think most of my employees have a working spouse. So I know what I pay them. I know their income is at least that. And I'm going to add a 25% load on that or a 50% load on that as an assumption that they have additional annual income. It's just that if you're guessing, you might turn out to be wrong, and then that could expose you to some penalties. So IRS actually has come up with a system for this, and it's sort of entertaining because they call it a safe harbor. And it is helpful to employers because it helps to give you some administrative certainty, but basically we have the IRS telling you it's okay to rely on a smaller number. You know what I mean? Because these are the safe harbors. Let's walk through them. So as an employer, since you don't know what your employee's household income is, you can choose one of three of these safe harbors to use instead. One is current year W-2 income. So you, the employer, know what you're paying, right? That's a known variable to you. The only thing about current year W-2 income is you don't know where it's going to end up at the end of the year if you have employees who work variable hours throughout the year. So if you want to figure out how much to charge somebody for coverage, and you got to make sure you steer it in under 9.5% by the end of the year, you're going to have to figure out a way to do that. Now maybe you think you can kind of take a guess as to where they're going to end up. This is where that 9.5% load on every dollar works, because then you're never charging them more than 9.5% of what they're being paid that year. So that's one way to do it. But in any event, it's a known variable, so that's something you can use as an employer. The next safe harbor is called the rate of pay safe harbor. For a salaried employee, this is fairly easy, right? You know what their monthly salary is. So as long as what you're charging them for coverage is no more than 9.5% of that monthly salary, then you're good. You know it's affordable. With an hourly employee, it's a little more complicated because what they said is, okay, you have to take the employee's hourly rate of pay and multiply it by 130, which is the minimum standard for hourly, and kind of treat that like a monthly salary. And as long as what you're charging them is no more than 9.5% of that, then you know your coverage is affordable. The problem is most of your employees, even the hourly ones, probably work a heck of a lot more than 130. So in some respects, you might be cheating yourself and using a lower number. But if you're looking for administrative certainty, that might be helpful. The last one is the one that I think is the most useful from an administrative standpoint, although you're probably going to be charging a heck of a lot less than you could, and that is this federal poverty line safe harbor. Basically, if you look at the federal poverty line for a single individual, as long as you're not charging more than 9.5% of that, then your coverage is deemed affordable. So if you look at the existing federal poverty line and you do the math, $90.96 a month. So if your lowest cost employee-only coverage will not cost an employee any more than $90.96 a month, then you can rest assured that it is deemed affordable for all employees, regardless of their income level. So I have a lot of clients that are using that just because it's easy. You don't have to worry about doing the math for every single employee. But you go back to my example of that employee with $30,000 in income. Remember, you could charge him up to $237.50 a month. If you're only charging him $90.96, you're basically just spending some money for the administrative certainty and not have to go through the work. But it is something that can be useful. So that's what you would do. Some employers, again, are saying, well, why cheat myself with one of these safe harbors? I know that this guy has a second job. I know he has a working spouse. So I'm going to build into my assumptions some additional income and hope that I get it right. And we'll talk in a minute about what the penalty exposure would be if you don't get it right. Any questions about that?
Now he has, or she has no health coverage.
Yeah.
What happens then?
Well, I mean, there are lots of reasons an employee wouldn't take you up on your offer of coverage. I mean, one might be that they just can't afford it. One might be that they don't care. They don't think they need the coverage. If they want coverage and they don't take your offer, It may be because they're getting coverage from their spouse's employer. It may be because they're on Medicaid, depending on what their income is, or if they're older, they're on Medicare. It may be because they looked at the exchange and decided to buy the coverage there. Remember, just because you make an offer of coverage, it doesn't cut the person out of exchange coverage. It just cuts them out of the subsidy. So going back to the example I used earlier, you go to the exchange and the full boat cost of the coverage is $250, but because of a guy's income, he may only pay $25 a month. If you make him an offer of coverage that's affordable, he can't get that subsidy, but he could still go pay the $250 a month to buy the coverage if he wanted to pay full boat for it. Whether somebody would do that is probably unlikely, but that's still another opportunity where they could get coverage. And there are still carriers that are selling individual policies, so it's possible they might go somewhere else. But by and large, if you have folks who aren't taking you up on the offer, it's because they're getting the coverage from their spouse or their parents if they're young enough, or they just don't care and they're going without and they're willing to pay that penalty. So I think I may have covered some of this, but let's just make sure. So yeah, the affordability is on that lowest cost. You can still have the buy-up options. Dependent coverage has to be offered, but it doesn't have to be subsidized. And an offer, that's all that's required. They don't have to take you up on it. One more thing to note, which is sort of quirky, but you may have read this. The IRS has said that spouses don't count as dependents. So when the rule says you have to make an offer of coverage to the employee and their dependents, you don't have to make an offer to the spouse. And we are actually starting to see group policies sold by carriers that don't have spousal coverage. Now that sounds kind of absurd, right? That you would have coverage but not cover the spouse but cover the kids. But there's a reason why IRS said that, and that is if you're not making an offer of coverage to the spouse, guess what? That frees them up to go to the exchange and get a tax subsidy. Because if they are offered coverage under the plan, then that cuts them out of their exchange subsidy. So,
could they go to the exchange and get a family plan?
Well, that's something that's up to debate about the family plan. In other words, if you don't cover the spouse, so they go to the exchange, and then they want to cover the kids that are also covered by the employee, what the result should be is that no, the kids can't get a subsidy because they're part of the employee's plan. But it's interesting, there's been some regulators who've made informal comments that they don't think that's the way it's supposed to work. So we're going to have to wait and see what happens there. There's also some maneuvering you could do from an individual tax standpoint where you could do married filing jointly and try to put the kids under the spouse that's not covered. That's the question, is whether that type of tax planning could get you there. But that's up in the air right now as to what the result is, believe it or not. Okay. So we've talked about what it means to play. Let's talk about the other side of the fence, because it's at this point in the program where oftentimes, I can see it in the faces of the crowd. It's just, tell me what the penalty is. Okay, I'm done, right? This is just, it's too complicated. I don't have the time for this. Tell me what the penalty is and I will write the check. Okay, well let's talk about that. And remember, we're still just talking about large employers, 50 or more. So if you do that, if you say, look, I'm out of it, tell me what the check is. I'm not going to make an offer of coverage to anybody. You're getting out of the game. The penalty is $2,000 per year per full-time employee, excluding the first 30. So let's move forward and look at my example real quick just to get this on the table. So you have 100 full-time employees. They give you a break on the first 30, all right? So you subtract the 30, that leaves you with 70. You multiply that by $2,000 a year. You pay $140,000 excise tax for the privilege of not providing coverage to your full-time employees. That's the I'm going to get out of the game penalty. Now, technically, this penalty only applies if at least one of your employees goes out and gets subsidized exchange coverage because you didn't make them an offer of coverage. You can rest assured that's going to happen, right? If you don't make an offer, at least one of your employees is going to go out and get exchange coverage. We talked about earlier about how the premiums assistance goes all the way up to 400% of the poverty level. You're going to have somebody go out and do it. You can rest assured. So that's the I'm getting out of the game penalty. Now, a couple of things. This $2,000 penalty is a non-deductible excise tax. So if you are a profitable tax-paying employer, there's a difference between paying the penalty and spending money on coverage. When you spend money on coverage for your employees, it's a tax-deductible expense like any other compensation expense. If you pay this penalty, it's non-deductible. So you have to take that into account when you're comparing the two. The other thing is, the $2,000 is an annual penalty. So if you only employ a full-time employee for half the year, you're going to pay $1,000 for that particular employee. It's metered out by month. It's about $167 a month. So if your workforce varies throughout the year, it's not like you're going to pay this $2,000 penalty for every full-time head that crosses your threshold. All right? It's going to be, this is based on employing somebody for the full year. The other thing to keep in mind is starting in 2016, this $2,000 penalty amount is indexed to medical premium inflation. So it's not going to be fixed there forever. I have a lot of employers who look at this and they say, now wait a minute, I spend a heck of a lot more than $2,000 a year providing coverage to my employees. Sign me up. If I can lock it into $2,000 and just be done with it, I'm happy to do that. The problem is every year your premiums go up. Well, the same thing's going to happen with this tax starting in 2016. Yeah, before we know it, this will be $4,000 a year. So don't assume that this is going to be fixed in time. It's going to go up at a pretty heavy inflationary rate going forward. So that's the penalty if you get out of the game. There's a second penalty that you could be exposed to as an employer, and this is the employer who tries to play. So you make that offer of coverage to substantially all your full-time employees, but somewhere you fall short. And most likely where you would fall short is that the coverage ends up being unaffordable for somebody. So going back to my household income example, let's say that you take the W-2 income for each employee for the year and you add a 50% load on top of it as your assumption of what their household income is. And let's say you turn out to be wrong. And so what you thought was a 9.5% charge for a particular individual ends up being 13%. If that person instead goes to the exchange and gets a tax subsidy because your coverage is not affordable, you would then pay a $3,000 penalty for each employee who actually goes out and does that, goes to the exchange, gets a subsidy because your coverage is unaffordable. So there's a key difference here between the $2,000 penalty and the $3,000. The $2,000 penalty is a guaranteed, per head penalty, excluding the first 30. The $3,000 penalty is only for an employee who actually goes to the exchange and gets that subsidy because your coverage was unaffordable. Now, I used to tell my clients, look, if you're going to play, you're going to go through all the trouble to put coverage in place. Make sure it's affordable for everybody. Don't go through all that trouble and then still expose yourself to this penalty. And by and large, I think that's true. That's probably the most sensible strategy. But I do have some clients who said, you know what? It's actually cheaper for me to pay a $3,000 penalty for a handful of people than to lower my premiums all the way down to a point where it's going to be affordable for everybody. So I'm willing to take the chance that maybe a handful of my lowest paid people will actually go out to the exchange, get a subsidy, and cost me this $3,000 penalty because that's cheaper than the alternative for me. So that may be the case. I mean, I've had some clients say, look, I've always paid 20%, or I've always paid 80%, employee pays 20%. I'm just going to stick with that. And if it turns out that for my lowest paid folks, it would be unaffordable, I'll fork over this penalty for whoever I need to. And then of course, they're going to have to wait and see how it shakes out because you don't know how many of those low-paid people are going to go to the exchange. But that's certainly something that you could consider when you're doing some planning. Just a quick example on this one. Your lowest paid folks, again, you set your premiums wherever they are. Let's say you have 5 people. Your lowest paid 5 people, they'd have to come out of pocket, 12%, let's say, for your coverage. If only 3 of them go out to the exchange, the other 2 just go without, or they get it from their spouse, however they do it, you're only going to pay that penalty for the 3 times $3,000. Now, same thing on this $3,000 penalty. It's non-deductible excise tax. It's metered out by month, so it's $250 a month for each month that you employ that full-time person. And it's indexed to medical premium inflation, so it's going to go up over time as well. We talked about the deductibility. Now earlier I talked about controlled groups where you have the guy that owns the farm, the car dealership, and the gas station. All three get tied together for the 50 or more test. But once you get past that, each separate business can make its own player pay decision. So I could decide that it makes sense to pay the penalty for the gas station, but to put a plan in place for the farm and the car dealership. And that's okay. As long as each business is in its own separate legal entity with a separate EIN, you can make a separate decision for each business, even though they're all closely related and counted together for the 50 or more test. Now, some of you probably heard of this concept of the skinny plan. Been a lot written about this. It's kind of universally viewed as a loophole around healthcare reform. It's not quite the loophole that a lot of employers think it is. And to the extent that it's been pitched to some of you, I want to make sure you understand what it means. So the biggest thing you want to avoid as a large employer is that guaranteed $2,000 per head penalty. Right? That's the one that you want to get around. So the idea of the skinny plan is that you're going to make an offer of coverage that is something that gets you out of that $2,000 per head penalty. But the offer you're going to make is not going to be affordable, and it sure as heck isn't going to be minimum value. It's going to be one of these plans that some people might ask, what are they worth, right? Where you can go to the hospital once a year, but we only cover up to $5,000, or you can only see a doctor 3 times a year. Very minimal level of benefits. But by offering that to your employees, and a very cheap product too, by offering it to your employees, you get out of the $2,000 per head penalty. What you don't get out of is the $3,000 penalty. So if you make an offer of one of these so-called skinny plans to your employees, because it's really cheap and it's the easiest way to avoid the across-the-board penalty, just know that you're still at risk if any of those employees decide to go to the exchange instead, buy their coverage there and get a tax subsidy. Because for each one that does, it's going to cost you a $3,000 penalty. Now, the theory behind the skinny plans, if you talk to the folks that are promoting these products, is that the skinny plan you offer is going to be just good enough that nobody's going to be motivated enough to go out and get exchange coverage. It's going to be cheap. It's going to give them just enough benefits so they feel like they have some coverage in place, and they're not going to be motivated to go buy exchange coverage instead. That's the theory. But just know, if you're being pitched that product, that you really won't know until you get to the end of the year how many people do go out and get the exchange coverage, and by doing so, end up costing you this $3,000 penalty. So you're kind of taking a gamble when you do that skinny plan. I've seen that plan marketed a fair amount in the ag industry. Some of you probably have had the pitch. I just want to make sure you understand it. Now, the biggest thing you can do as a large employer to try to deal with the mandate and these obligations is to manage who's going to count as full-time. A little while ago I was talking about that 28-hour-a-week waiter. Well, that's one way to do it. Now, I don't know about you, but what I hear from most of my ag clients is that's just not going to happen from an operational standpoint. There's no way to run my operation with part-time employees, okay? And I see everybody shaking their heads out there. So you probably have the same experience. So that's probably not going to be a very viable strategy for you. But there's another way to manage who counts as full-time, and that's this so-called measurement period and stability period concept that the IRS has come out with. Now, if you just look at the statute for healthcare reform, whether or not somebody's full-time is actually a month-by-month determination. So literally, you would look at each month and say, okay, did they work 130 hours? Yes, they're full-time. The next month, maybe they don't. So in theory, you could have people kind of bouncing in and out of full-time status for purposes of all these rules. The problem is that's not very workable for you as an employer. It's not very workable for an employee either. They get coverage one month, they don't get it the next month. It just doesn't work. So the idea behind the measurement period is you're going to smooth out that process. that what you're going to do is you're going to take that hourly employee and measure their hours over a longer period of time, between 3 and 12 months. And then if they make the cut, if they average 30 or more a week, you would then treat them as a full-time employee for basically an equal period that follows. So if you're going to use 12 months to measure their hours, if they make the cut, you have to treat them as a full-time employee for the next 12 months, regardless of how much they work during that time period. Likewise, if they don't make the cut, you would then have the ability to treat them as a part-time employee for the next 12 months, regardless of how many hours they work. This is a useful tool for the ag business and a lot of other businesses with variable hour employees to try to manage who ends up counting as full-time. But I want to make sure you understand a couple of key distinctions because there's a lot of confusion about this rule. Basically, when you hire a new employee, you're going to have to put them in one of three buckets. They're a full-time employee, non-seasonal. They're a variable hour employee who is not expected to work 30 hours a week, or they're a seasonal employee, regardless of how much they might work. Now, for somebody who's non-seasonal full-time, you can't make them run through one of these measurement periods in order to qualify. They're a full-time employee out of the gate. You can apply this 90-day waiting period, but after that, you got to offer coverage. If you don't offer coverage, you're going to be subject to the penalty. That's for a full-timer. That's somebody you're hiring into, like a designated full-time position. For variable hour employees, you can run them through one of these measurement periods only if at the time of hire you look at them and you say, they are not likely to average 30 hours a week. Now, how would you make that determination? Well, maybe traditionally you've had a handful of part-timers that you use on an on-call basis, and historically, they've averaged 15, 20, 25 hours a week, whatever it is. If you're hiring somebody into that type of position, well, then you can basically run them through a 12-month period before you'd have to do anything for them. The key distinction and help for the ag industry is if somebody is a seasonal employee, then you're allowed to run them through that 12-month period no matter what, even if out of the gate they were going to work 60 hours a week. And the key is, though, they have to be a seasonal employee, all right? So seasonal farm labor. The expectation when you hire them is they are only going to work for a particular season. After that, they're going to be laid off or they're going to go south and do some work there. Even if you plan on having them back season after season, as long as the work they're doing is seasonal work, you can treat them as a seasonal employee and then run them through one of these 12-month measurement periods before you would have an obligation for them. And it's through this process that you can manage who's going to count as full-time. Because let's face it, you can bring somebody on and let's say for 3 or 4 months they're working 60 hours a week. But then, maybe they drop down to 40 and then 30 and then they leave and they go south for 6 months. Well, because they're gone for 6 months, you actually get to include that in the 12-month average. So it dilutes the average. So even though during the time they were actually working for you, they were working, 60, 50, 40 hours a week, because they're gone for 6 months, the average may be down below 30. And that may cause them to never qualify as a full-time employee, meaning that you would never have either an obligation to offer them coverage or to pay a penalty for them. That's how that concept is going to work. So basically, if you decide to do this, and of course you would, technically what you would do is you would set up an ongoing measurement cycle with your business. So let's say you have a calendar plan, January to the end of December, and you do your open enrollment, in November sometime. Probably what you would do is you would set up a regular measurement cycle of 12 months that runs from November 1st to October 31st. And then every year, you'd run the report after the end of October and see what people's hours look like for that prior measurement cycle. Whoever makes the cut, you offer them coverage during open enrollment. It starts January 1st and they go on with life. And you do that. It's just a regular measurement cycle every year. So you would set up this regular measurement cycle, and that would be in place for all your employees once they've been with you through a full cycle. But for new employees, the measurement period actually gets measured from their hire date. Because let's face it, you're not going to hire people necessarily at the beginning of one of those regular cycles every year. You're hiring people throughout the year. And so for new employees to come on board who are seasonal or variable hour, not expected to work more than 30, you could start a 12-month measurement period from their hire date, and you can wait until that 12-month anniversary to see if they made the cut. Are they even still around? First of all, I guess that's the first question. Secondly, if they are around, what was their average? And if they left and came back in the meantime, remember that gap is going to dilute their average. Now, one thing you need to keep in mind is there's this break-in service rule that basically says if somebody leaves your employment and they're gone for less than 6 months, when they come back, they basically step into the same shoes they were in when they left. And that's why you end up having this dilution. If you have somebody that leaves and comes back 4 or 5 months later, you're still going to measure them across that entire period, which included when they weren't work, but it's diluted by that time when they're gone. Now, if you have a 4-month season and you're hiring that same crew for 4 months every year, and then they're gone for 8 months, and then you hire them for another, well, guess what? They're gone for more than 6 months. So you get to treat them as a new employee every time they come back. You subject them to one of these 12-month measurement periods. Guess what? They never get in. They're never counted as a full-time employee. So if you have a season that's less than 6 months where you're not getting caught up in this break-in service rule, it may be that a lot of your seasonal work is never, ever going to qualify as a full-time employee, which means it doesn't matter if you have 80 employees, because 40 of them you're never going to have an obligation for under this law. It depends on your operations and the demographics of your workforce and how you're using them.
What was the length of time for the break-in service period?
6 months. So it's, and I'm the first to admit, this stuff is way overly complex. I get it. I was telling a client the other day that eligibility for health plans has now reached the complexity of pension plans. It used to be that, you got to hire somebody to figure all this stuff out for a pension plan. It's almost gotten to a point where you may have to hire somebody to figure it out for a group health plan, because these are pension-style eligibility rules, very technical rules, lots of little traps. But if you understand them and you use them right, you can use them to manage your obligations. Okay, a couple more things, and then we're gonna finish up here. In addition to the mandate, there's a couple of other kind of big things on the horizon that I think could have a significant impact on some of your businesses. One is an automatic enrollment requirement. So this is going to apply to, I guess, extra large employers of 200 or more full-time employees. If you fit into that demographic, as soon as the Department of Labor comes out with regulations, you're going to have to institute an automatic enrollment program. And what that means is somebody comes to work for you, they meet the eligibility requirements for your plan. Instead of handing them papers saying, sign up if you want to, you would hand them papers saying, you are signed up unless you fill this out and opt out. And time after time, studies have proven that the same people who are too lazy to fill out the paperwork to sign up are too lazy to fill it out to opt out. And so automatic enrollment statistically is going to increase the number of people taking your plan. So if you're in that 200 or more space, just know that at some point in the next probably year or two, those rules are going to come out, and you're going to have that, flip your enrollment process, and it'll probably increase the amount of folks who take you up on your offer of coverage. The other thing that's out there on the relative near-term horizon is some non-discrimination rules. And these rules are attempt to prevent you from discriminating in favor of what they call highly paid employees. For this purpose, a highly paid employee is somebody who's in the top 25% of annual pay. So if you look back to last year and you ranked everybody by annual pay, largest to smallest, the top 25% of the people would be considered highly paid employees, regardless of what their actual pay is. It's all relative. And basically, you'd be prohibited from discriminating in favor of those folks in the features of your plan. So how might you discriminate? Well, it's not uncommon to have a plan in place where you give it to the family, you give it to the supervisors, some of your managers, but you don't give it to everybody else. Well, that's a situation where most likely you're benefiting the highly paid employees, right? The managers, the family, the supervisor, at the expense of others. So that's something that may not work. A lot of employers have systems where maybe they offer the plan to everybody, but it's fully paid for the family and for the managers, but everybody else has to pay 50% of the premium, something like that. Basically what I tell clients is if you have any type of class system in your plan regarding how much people pay, eligibility, what plans are made available to them, that type of class system will most likely not work when IRS eventually comes out with these discrimination rules. Now, you don't have to go and turn anything upside down just yet if you have class systems at your business because we're waiting for the rules. And until the rules come out, we won't know exactly what you would even need to do. So just know that if you have a class system, it may be at some point in the future you're going to have to unwind that and basically make a uniform offer of coverage to everybody who's eligible for the plan. And the reality is there are workarounds. I mean, for those of you who pay 100% of the coverage for the family or for the managers, all you have to do is start charging them the same thing you charge everybody else and then increase their pay so it's a net even, right? So there are ways to deal with this if you have a class system that's just related to how much people pay. But wait until the rules come out and just know that you may have to make some adjustments as a result of that. Okay.
If the lower paid people are paying less than the higher paid people.
Absolutely. There is, and I've actually seen this quote from the IRS, there is no such thing as discriminating in favor of non-highly paid employees. You can discriminate in favor of them all you want. Yeah, that's never a problem to charge the lower paids less.
That applies to the 50 or more, not just 200 or more?
Yeah, let me back up. These discrimination rules apply to all employers regardless of size. So even if you're under 50, if you've decided to have a plan in place and you have a class system, you may have to make an adjustment once these rules come out. I'm glad you asked that question.
What happens if an employee is within their 90-day wait to be offered insurance to the employer and they receive a subsidy through?
Good question. What about somebody that's in their 90-day waiting period and they get a subsidy from the exchange? The rules are such that you would never have to pay a penalty for somebody during that 90-day waiting period. So if you have somebody that maybe you hire them and they have exchange coverage and they're going to keep it until you make your offer, you don't have to worry about being exposed to a penalty for them. All right, let me finish up here, and then I promise I will stick around as long as anybody wants to come up and talk about any specific questions that they have. So what should you be doing now? I know that all of you are going to have plenty of time in your hands when you get back to your office. Well, number one, you've got to model the impact of this. I don't care what size you are. If you're under 50, great. Just make sure you're comfortable you're under 50 based on the mechanics of that. And then if you're under 50, you got to do this analysis. What's best for my employees? Should I offer a plan? Should I not? If I do, how should I price it? Should I free them up to go get the government money? You got to take a look at that. Obviously, it's a much bigger analysis for a large employer. If you're 50 or more, you're factoring in, do I want to pay the penalty? How much is that going to cost me? Do I want to do something to try to reduce my workforce to get under the 50? In any event, you need to take a look at it. I've sat down with a lot of clients and helped them run the numbers, and universally there are surprises. You know, you can look at it and say, oh, well, there's no question it'd be cheaper for me to pay the penalty, and sure enough, when you pencil it out, it's not. So I would encourage you, if you haven't already done so, to sit down and pencil that out. Way back at the beginning, it seems like so long ago, I was talking about all the non-mandate stuff, right? Getting those disclosures out, things like that. Make sure you're on top of that. I call these the ongoing compliance obligations. You want to make sure you're addressing that stuff. And then keep an eye out. As I mentioned, we're waiting for the final regs from IRS. Hopefully they'll tell us whether or not you can wait till your plan renewal date or not. There will probably be some other little surprises. We're all holding out hope that they might simplify some of this. We'll see what happens. On the heels of that, we're going to get the guidance from IRS on the tax reporting. That's something you're going to have to do if you're a large employer. all this stuff, you're going to have to give new information to IRS so they can regulate it and figure out whether you owe a tax. So you want to keep an eye out for that. And then remember, there's a lot more to come even when we get over this hump. I mean, we have that exchange notice. We're still waiting for them to come out with kind of final regs and what the penalty will be for not giving it out. We talked about non-discrimination, the automatic enrollment. We didn't even get to the Cadillac tax, right? Starting in 2018, if your plan is too rich, you might actually pay an excise tax because you're giving away too much to your employees, believe it or not. That's the so-called Cadillac tax. Now, whether that's ever going to come to pass, we don't know. The politics of it are sort of interesting. But the main point is, unfortunately, I hate to break the news to you, you're probably going to be coming to things like this for the next few years because healthcare reform is going to continue to evolve, and every year we have kind of new things coming to pass that become effective that you're going to want to make sure you know about, how it's going to affect your business, that type of thing. So keep an eye out, and I'm sure that Farm Credit's going to help keep you informed. So you got a great resource in them. Since I've run over time a little bit, I'm going to go ahead and conclude the program, but I will stick around and take any questions that anybody wants to ask. Thank you very much for your attention today. I appreciate it. I know this stuff is tedious, but it's been a great group.